All right. So welcome everybody to this lunch and learn, or breakfast and learn, or dinner and learn, or wherever you are at. This time we'll have with us Allan from the University of Cape Town. He's a senior lecturer there at the economics department, and he's also the head of the FinTech hub that we just started the partnership with at the foundation. And Allan is gonna teach us all about double entry bookkeeping. So here we go. I can't hear your sound. I don't know if it's just me. You are not muted. Your lips were moving. Is it just me?
I couldn't hear.
No, it's everyone, I think.
No. First the screen, then the headphones. No.
Okay, can you hear me now?
Yep, all good.
Okay, let's try to share now and let's see if okay. Can you hear me now?
Yes.
Okay, there we go. Good. Okay, and you can see the screen as well.
Indeed. All
okay,
good.
Fantastic. Okay, let me okay, great. So thank you to Sabina for the invitation to chat to everyone today, or to tell you a bit more about double entry bookkeeping. Now, I think it's worth putting up a few disclaimers before I start. So firstly, I am an economist by training and not an accountant. So you should not, please don't take anything I say as accounting advice or accounting insights. People always hate economists because they have strong opinions about things that are somewhat unrelated to their field. This is probably another example of that. But while I'm not an accountant by training, I'm an economist by training, so I do know a lot about markets, payments, and financial institutions. So I'm going to leverage that knowledge today to just walk you through some of the main principles behind financial reporting quite briefly, and then sort of speak through the two types of bookkeeping, single entry and double entry, that are the sort of dominant paradigms in terms of how we keep records of financial accounts. And I should say, if anyone has any questions or any clarification, please feel free to hop in throughout the presentation. Okay, financial reporting. So if we speak about the concept of financial reporting or speak about a financial report, what do we refer to specifically? So the IFRS, the International Financial Reporting Standards, that is essentially the global, in a sense, governing body who is responsible for setting the accounting standards that the rest of the profession follows. They define financial reporting as providing financial information about an entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to that entity. So there's two sort of main components of this definition. The first is that financial reporting provides financial information. So what is financial information? You can think of financial information as anything that relates to the income, the expenses, the assets, or the liabilities of a company. So anything that tells you about profit or loss or net worth. And financial reports are useful, or is a useful piece of information to entities such as investors, lenders, and other creditors. So if you think of an investor, if you are a VC and you're looking to invest in a startup, the first thing you're going to ask for are things like the cap table, the income statement, the balance sheet. So these financial reports sort of provide a diagnostic report or diagnostic insight into the sort of state of a financial or a business entity. Now, importantly, all firms that are formally registered, so what's a formally registered firm? This is a firm that is registered in their country with the company's registrar, so there's a company registration number. All of these firms are required by legislation across the world to provide or prepare financial reports at the end of every year or at the end of every financial year. These reports are typically subject to an external audit so that there's some third-party verification of the information. And in almost all jurisdictions around the world, there are severe punishments for the lack of reporting. So if you are late to submit your reports, or you fail to submit it, you could get fined. In many cases, the fines are a flat amount, but in some cases, the fines are a percentage of the size of the company. And in severe cases, if you are non-compliant with respect to financial reporting, a government is actually able to suspend your company license. So financial reporting is a necessity, and all firms need to do it. Now, you'll note in the previous definition, I speak about all formally registered firms. Now, while not required by law, informal firms will typically also prepare some or other basic form of financial report. What is an informal firm? Think of a street vendor selling vegetables on the corner of a street. So in a sense, sort of think of low levels of financial sophistication. This isn't necessarily a complex good or service being sold. So if you think of that street vendor selling vegetables on the side of the road, at the most basic level, that vendor needs to know whether or not they've made a profit or a loss. And in order to do that, that vendor needs to keep an account of all income being made. So sort of how many, what's the quantity of fruit being sold every day. But they also need to keep an account of the expenses they're incurring. So whether that's fertilizer, whether that's water, electricity, so that at the end of the day, they're able to go income minus expenses and see whether or not they've made a profit or a loss. So while not required by law, even informal firms do some form of financial reporting, even if it's just as basic as keeping a record of income or expenses. So if we think of the types of financial reports, there are really two main types. There are four in total, but we'll focus on two specifically today. The first being the income statement and the second being the balance sheet. Now, the income statement is quite simple to understand. The definition's almost in the name. It is a reflection of all money coming into the company. So you can think of that as income or revenue from sales, and an account of all expenses, so all money being spent by the company. Income minus expenses, if that number is positive, a company makes a profit. If that number is negative, a company makes a loss. Fairly straightforward. The second main type of financial report is what we call the balance sheet. And the balance sheet reflects three things, and these are going to be three important components for thinking about double entry bookkeeping. Those are assets, which is anything that the company owns. So if a company has bought an office building, that's an asset. If a company's bought laptops for its employees, that's an asset. It includes liabilities. Liabilities here refer to any obligation the company has to another party. An obligation here refers to an obligation or a promise to pay a certain amount back. So think of this as a loan. If I take out a loan of $100,000 in order to expand my business, at some point I need to pay that loan back. I have an obligation to pay that loan back. That loan is a liability. And then the third type of the third source of financial information that appears on a balance sheet is equity. And equity here refers to the ownership of the capital within the company. So if it's a startup and there's only one founder, that founder holds all the equity. But as that company starts to mature and make profits every year, any profits that are retained within the company are also reflected under equity. So you can sort of think of a balance sheet then as providing a view of the net worth of a company, while an income statement tells you something about the profitability of that company. There are two other types of financial reports that are less relevant for our exercise today, and that is a cash flow statement, which is really just a reflection of the liquidity and the solvency of the company, and a statement of changes in equity. And this is essentially just a yearly report which speaks to any changes in dividends or equity that happens throughout the year. Okay, so on to bookkeeping. So if you sort of think of financial reports as being this really important and necessary thing that all firms need to compile, you can think of bookkeeping as sort of the art of creating a financial report. So the definition I have on the slide here is bookkeeping involves the recording of a company's financial transactions on a regular basis. And I'm quite deliberate here with the term financial transactions and not just transactions, because if you think of what constitutes a transaction, this refers to the purchase and sale of goods and services within a company. So it's a company hiring a consultant, it's a manufacturing company purchasing a piece of equipment to use in the production of goods. So when we refer to financial transactions, it includes sort of all of these sort of typical transactions, but it also includes any transaction that results in a change to the value of assets, liabilities, or equity in a business. So taking on an additional loan is an example of a financial transaction. A co-founder making an additional top-up investment into the company for more equity is a financial transaction. Or a company purchasing an office block, for example, is a financial transaction as well. So when it comes to bookkeeping, there are two main approaches, single entry and double entry. We'll look through both of these approaches quite briefly over the next few slides, although double entry bookkeeping is commonplace and is definitely the accounting standard and has been for hundreds of years. So single entry bookkeeping. Please excuse all of the sort of hand-drawn figures coming up here. This is going to take way too long to do nicely in Adobe or anything, so you'll just have to do with my handwritten slides on my iPad. So single entry bookkeeping, what is it? A simple way to think of single entry bookkeeping is that it is a method of bookkeeping that involves keeping an income statement. So if you think of what an income statement is, an income statement is an example of single entry bookkeeping. And the idea behind single entry bookkeeping is quite intuitive, quite easy to understand. Income is recorded separately from expenses. Income and expenses determine profits or loss. But importantly, every entry that is made is only made once. Right? There is never a corresponding entry. That may sound a bit unclear, but I think the idea of a corresponding entry will make a lot more sense when we think of double entry bookkeeping. So at a most basic sense on the slide over here, imagine the fruit vendor who's had an amazing month. The social media campaign has gone really well. There's been a lot of foot traffic past the fruit store, resulting in $10,000 of sales. You can think we reflect that as money coming into the company, so we put it on the left of this statement over here, and in the production of that revenue, the fruit vendor incurred $8,000 of expenses. Quite easily, then sales minus expenses is profit. You'll see it in green there. If expenses was bigger than sales, we'd still record it on the left, but it would be a negative number and it would appear in red. Now, the nice thing about single entry bookkeeping is that we can essentially just flip this representation from a left and a right column to a vertical one, and we get an income statement. So single entry bookkeeping on the previous slide is equivalent to an income statement, right? So we'll sort of see everything here on the income statement that we saw on the previous slide. Instead of being reflected on the right-hand side of a two-sided account, expenses, anything that is to be subtracted, gets put in a bracket and we see a profit over here. So whenever any firm compiles an income statement, they are doing single entry bookkeeping, right? So single entry bookkeeping is an exercise which results in an income statement. Why can we do that? Well, because an income statement only involves two things. It only involves income and it involves expenses. So we don't have other asset classes to worry about. And as a result, a very basic reporting structure suffices to deal with that low level of financial complexity. And until about the late 15th century, single entry bookkeeping was the dominant form of accounting around the world. In fact, today, again, back to the example of sort of the informal firm, Single entry bookkeeping is still quite sufficient. For many consultants, single entry bookkeeping is also entirely sufficient. So think of someone that is a consultant that starts a company and consults through the company. A single consultant really only has to keep track of sort of income and expenses. There's no major sort of assets or sort of equity. So for a consultant, it could even be the case that single entry bookkeeping would suffice, because all they need to be concerned about is the recording of income and expenses. But around the 14th to 15th century, the nature of firms start changing. A lot of this is driven by what's happening in Italy at the time, with the Medici family and the Medici Bank in Italy, which is sort of historically the sort of most famous bank, one of the most important financial institutions in our modern financial history. Companies start to acquire assets, companies start to take loans from one another, and companies start to take on investment, which necessitates equity. So we're now sort of introduced to three new concepts that we'd not seen up till the 15th century: the idea of an asset, the idea of a loan or a liability, and the idea of equity. And as I'm sure it's quite obvious, at this point, single entry bookkeeping, which really just focuses on the flow of income and expenses, is unable to sort of meet this increasing complexity. And this sort of promotes the sort of development of a system of bookkeeping, which today we call double entry bookkeeping. Now, quite interestingly, the first example of double entry bookkeeping occurs in Italy around the year 1300. And there are many other examples of double entry bookkeeping that follows that. But the rules of double entry bookkeeping are essentially only codified around 1494 by a gentleman called Luca Pacioli, who is still up to today called the father of accounting. And in pretty much everything I'm going to show you over the next few slides can still be found in that text written in 1494. So this is the amazing thing about double entry bookkeeping, is sort of, since it's been formally codified in 1494, the rules have largely remained unchanged. And this sort of speaks to sort of how intuitive of a system of account this is. So if you think back to my analogy from earlier, that single entry bookkeeping is the sort of ingredient or the necessary step to produce an income statement, double entry bookkeeping is going to be the necessary step in order to prepare a company balance sheet. So what do I mean when I refer to a balance sheet? Well, a balance sheet reports a company's assets, and importantly, how those assets were financed. And financing here can happen in one of two ways. It can happen through debt, which we think of as a liability, or equity. So while an income statement shows you profitability, a balance sheet is going to show you a reflection of a company's net worth. So on the slide over here, I've got sort of the three categories, starting with assets on the left. What is a company asset? Imagine a company bought an office building, that's an asset. Companies bought a bunch of laptops, printers, monitors, that's an asset. An asset could also be something that's, in a sense, less physically tangible. It could also be something like intellectual property, trademarks, patents as well. Liabilities in the middle, there are two main sort of categories of liabilities: current and non-current. Current here refers to any obligation that the company has that needs to be resolved within the next year. So a company needs to pay someone or repay something, and that has to happen in the next year. Non-current liabilities refer to any obligation that the company must meet beyond the next year. Right? So if you think of what a current liability is, this is payroll. So a company needs to pay salaries, company needs to pay rent, and a company may have accounts. So there could be a Dropbox account and a Pro license for Google, etc., etc. What are examples of non-current liabilities? A company may have taken out a fairly substantial loan or a bond where the company needs to pay a sort of large amount, or what we call a balloon payment, at the end of the loan. So the company pays a small amount each month and then has to pay, let's say, $100,000 at the termination. It could also be something like pensions or retirement programs. So if a company offers a retirement benefit, if you're in the US, this is a 401 401k or an IRA. At some point into the future, when the person retires, that payment needs to get made. So that's a form of a liability, a non-current liability, because it's out. It sort of is into the future and not the current. Finally, if you think about equity, this refers to one of two things: investment made into the company that's rewarded with equity or capital, and any retained earnings. So what are retained earnings? A company makes a profit, a company has shareholders, it can do one of two things with that profit. It can pay that profit as a dividend to its shareholders, or it can keep that profit in the company and use that to reinvest in the company. So we can sort of think of any earnings that is retained in the company and not paid out as a dividend as being a form of equity as well. Okay, so as I hope was quite evident in the name, balance sheets, all balance sheets must balance. What do I mean by balance? The way to think about it is the accounting equation needs to hold. This is a very famous equation. Hopefully many of you would have seen this or know about it. But the idea behind a balance sheet is that the value of the assets on a balance sheet should be equal to the sum of all liabilities in a company plus the sum of all the equity in the company. Now, why must that accounting equation hold? So let me try to hopefully explain the intuition behind this. So if you think of everything that a company owns, right? So you can think of this again as any physical assets, office building, equipment, laptops, anything like this, right? Intellectual property, patents, right? Anything the company owns. For a company to have owned that or procured those assets must have been made or produced by some people. They can't just come into existence out of thin air. So if it's IP, that IP must have been created by someone. Or, for example, if the company's bought an office and they've used a loan to purchase that office, that asset must have been funded by a loan, right? So everything the company owns must have either been produced by someone or produced by a set of people, or it must have been funded by loans. And everything else that the company owns that has not been produced by people in the company or funded by loans must have been provided by the owners in the form of equity. Right? So if you think of all of the company's assets that must have been produced, it must have been the result of being bought through a loan, or it must have been procured by equity invested by the founders, right? There's no other way for those assets to have come about. Now, importantly, this accounting identity must hold in all other ways as well, right? So similarly, equity needs to be equal to assets minus liabilities. So again, everything the company owns minus the money it owes to the people or the institutions that helped create those assets must have come and therefore belong to the owners, right? So everything the company owns minus what the company paid to people to produce that, whatever difference there, must have been funded by the owners. Simultaneously, liabilities is equal to assets minus equity. So everything the company owns minus the contribution of the owners must have been created and must, in a sense, belong to the people or the institutions that helped create those assets. Right? And how the accounting equation relates to the balance sheet, you can think of the balance sheet as being a snapshot of the accounting equation at any given point in time. Okay, so now that we sort of have an idea about the accounting equation, how does double entry bookkeeping work? Now, the sort of major change with double entry bookkeeping from single entry bookkeeping is that we're no longer thinking about sort of money in a sense. So with the income statement, we're thinking about money coming into the company, money leaving the company. We replace those concepts with the concepts of debit and credit when it comes to double entry bookkeeping. And we can think of double entry bookkeeping as recording any type of financial transaction. And you remember from earlier, a financial transaction is anything that changes the value of assets, liabilities, and equity. And as a result of the accounting equation, we know that everything must balance, right? And the way double entry bookkeeping is going to achieve this is that if you go back to the accounting equation over here, any transaction that's going to change the level of asset on the left-hand side must by definition also alter the level of liabilities or equity on the right-hand side in order for that equation to hold. So we're always going to be making two transactions, and we're going to be making one transaction on the left-hand side of this equation and one on the right-hand side. So where single entry bookkeeping had a single account, right? It was just income and expenses. Double entry bookkeeping works through numerous accounts, or what we call ledgers. So for every business activity or every sort of subset of assets, every subset of ledger, of liabilities, and every subset of equity, there is going to be a specific account for transactions that affect those things. So for example, in the sort of asset side, there's going to be a cash account, which is going to reflect any changes to the level of cash within the company. There's going to be a land account, which is going to reflect any changes to the value of land that the company owns. There'll be an equipment account that's going to reflect any sort of changes in the equipment that the company owns. And together, all of these small accounts will give you the full view of the asset side of the company. So we're going to start breaking up assets by type. We're going to do the same for liabilities. Liabilities are generally a lot simpler. You typically consider a liability as either a loan, something you need to pay back, or accounts payable. And your accounts payable could just be your monthly Dropbox subscription. Equity is really only going to have one account, and that's going to be a retained earnings or a capital account. So we're going to have all of these mini accounts. We're going to sum all these mini accounts together, and we're going to get a balance sheet. Now, importantly, each of these mini accounts or mini ledgers need not and will not balance. So the sort of land asset ledger will not meet the accounting equation. The equipment account will not meet the accounting equation. Neither will the accounts payable account. But the totality of all of these mini accounts or ledgers must balance. So we're going to sum all these things together, and the sum of these mini accounts must balance. So that's a lot of theory. I'm going to work through an example now, which hopefully illustrates this quite clearly. This is a really important slide. All of the double entry bookkeeping can be summarized on this slide. So whenever some financial transaction occurs, we need to make a change to assets, and we need to make a change to either liabilities or equity. And the rule we're always going to follow is we debit the receiver and we credit the giver. Right? So whoever is receiving the benefit of the transaction gets debited. Whoever is giving that transaction, and again, this will become clear after an example, but whoever the giver is gets credited. And you'll see the rules over here. So if we're working in an asset account and the value of assets increase, we debit an account, decreases, we credit. Given that assets is on the left and liabilities and equity is on the right, the sort of relationship flips. So for an increase, we credit, and for a decrease, we debit. Okay, let's have a look at an example. So Sabina would like to start or starts a consulting company. So to think through this example, we're going to create 4 accounts here. So a bank account, right? So you can just think of this as the company's physical bank account, how much money the company has, and the money or the cash that a company has is an asset to the company. A capital account, which is going to reflect the capital invested into the company. So this is equity. So that's the capital account. An equipment account, which is going to be things that the company owns. So again, an asset. And we have this last thing here called AutoWorks. And this is going to be a car company that we're going to take a loan from in a few slides' time. And for every entity that we're taking a loan from, we're going to have a separate account for that entity. Okay, so Sabina starts a consulting company, and after saving up for many years, she builds up a sort of saving of $50,000, which she invests into the company. Right, so Sabina invests money into the company. Debit the receiver. Who gets the $50,000? The company does. right? So we debit the company's bank account, which makes sense. The value of the company's bank account increases. And who gave the company that $50,000? Credit the giver. Sabina was the giver, but we need to think in the structure of the company of Sabina as equity. So equity, $50,000 of equity gave the company $50,000 of capital, right? So we double side that entry over there. The company receives $50,000. Sabina gives, or sort of the equity in the company, gives the company that $50,000. The company, which in this case is Sabina, because she's the only person working there, decides to buy a MacBook for $2,000. Right now, who is giving the MacBook to Sabina? The company is. Okay, and we credit the giver. Okay, so the company is paying for that by cash, which means we credit the bank account of the company. Who receives the laptop? Well, Sabina does, but Sabina gets the laptop from the company, right? If there were many employees, I'm sure many of you have a company laptop. If you were to leave the company keeps the laptop. So the company buys itself a laptop and gives it to Sabina. So the company's equipment account increases by $2,000, right? Debit the receiver, credit the giver. Sabina then decides she needs a car, and decides that she doesn't want to use the remaining capital in the country to buy the car, and instead she wants to buy a car on credit for $25,000. So essentially take out a loan at a car company, which in our example here is called AutoWorks, and have that and have a loan pay for the car. So Sabina is going to, the company is going to buy the car. The company is going to gain an asset from AutoWorks, and that asset's going to be worth $25,000. So the equipment side, the debit side of the equipment account is going to increase. Who is giving the car to the company? Well, this is coming from AutoWorks. So AutoWorks have given a loan in order to provide the company with the car. So we're going to credit the account of AutoWorks. So again, in this example, every creditor here is getting a specific account. It could also just be that you have one generic loans account that sort of keeps everything there. All right. So again, the company gets a car, equipment goes up by 25, but it creates a loan that needs to be repaid by AutoWorks, who in this case is the giver. So we credit that account. Now, the question after all of these transactions is, does the accounting equation hold? Now, it's quite clear that the accounting equation in the bank account doesn't hold. It doesn't hold in the capital account, doesn't hold in the equipment account, nor does it hold in the AutoWorks account. However, if you think about all of the assets cumulatively here, so the bank account is an asset account. So we'll take debits minus credits, 50,000 minus 2,000. The equipment account is an asset as well, and that's 2,000 plus 25,000. So the value of assets in the company is $75,000. There's still a capital account with $50,000 in there, which is Sabina's initial investment. That stays there. And the liability for AutoWorks over here is still there. So that represents a liability. Assets 75,000 is equal to equity 50,000 plus liabilities 25,000. 75 is equal to 75, and the accounting equation holds. All right. So we can do a bunch of different transactions here. In this example, we had a purchase for cash, we had a purchase for credit, we had a capital investment, and you'll see that as long as you're following the rules of double entry bookkeeping, the balance sheet balances, and that accounting equation is always going to hold. While I should have had this on the screen here, you can also sort of start to see how going forward, we may start to think about balancing this equation. So for example, in the next period, we may decide to like pay off one installment of that AutoWorks loan. So that equipment account is going to get slightly lower, but then the value of that equipment on the left-hand side of the equipment account may also get lower because we're going to depreciate it by a period, for example. And in many cases, this sort of explained why there's always a link between the interest rate and the rate of depreciation, because you want the interest payment on the one side to sort of offset the rate of depreciation on the other side. But again, this is a sort of simplified example, but as long as you sort of have those rules up from the slide from earlier and you follow them, that accounting equation is always going to hold. And as long as the accounting equation holds, you are doing double entry bookkeeping. So yeah, why do we do double entry bookkeeping? Well, it's a very systematic way for us to reconcile assets, equity, and liabilities, right? And I think the sort of framework of thinking through assets as the sum of equity and liabilities is a very intuitive one, and sort of double entry bookkeeping and a balance sheet combined with single entry bookkeeping and an income statement, those two pieces of information give you a holistic view of the financial position of a company. But importantly, again, not all companies need to use double entry bookkeeping, right? So I think importantly, the need to want to use or implement double entry bookkeeping is tied to the need to have a balance sheet. So if you're the type of company that needs a balance sheet, you're the type of company that buys assets, and you're the type of company that has equity investments, you will need double entry bookkeeping. But for a very simplified company that doesn't have any assets or doesn't have any equity investments, single entry bookkeeping is more than sufficient. Yeah, I think that's everything from my side. So I don't know if anyone had any questions or anything they wanted to chat about.
Thank you, Allan, for your presentation.
Yeah.
I'm always like, the thing that kind of gets me is like the actual terminology about credit and debit, because I think,
Yeah,
like,
yeah,
if these seems like these accounts, they seem like they're almost like loan accounts, because I don't know,
yeah.
the debit, the receiver, credit, the giver, sort of how I would say we have a like almost backwards, I don't know, in the code, where I always say that the credit account is the one that's receiving the money. But I don't know if that's, I guess it depends on the type of account it is.
Completely. And I think like the terminology of debit and credit, if you sort of just think about a very basic income statement, like if you think of the flow of money, I almost want to say that notion of debit and credit is very different from the notion of debit and credit when you're implementing double entry bookkeeping. Those are sort of two fundamentally different concepts. In sort of this context, it's always, again, this debit the receiver, credit the giver. That's not to say that that sort of definition of what a debit and what a credit is always the one to use. But as long as you're trying to reconcile a view of assets and liabilities, that is the definition you'd have to implement.
Okay, so I guess it depends on, like, for example, just a very benign example is like, if I go and look at my checkings or savings account, anything that's coming in is a credit, as though which from a bank perspective makes sense, because they're like almost giving me, you know, their, how do I say, it's credit for
completely.
them.
Completely.
Okay.
Completely.
Okay.
Completely. Yeah. And like, but again, that's sort of in the domain of like a single entry bookkeeping world, right? Where we're only concerned about the flow of income. What money is coming into my account, what money is leaving my account. And in that context, sort of credit does refer to anything coming in. But the minute we think about a transaction affecting an asset and a liability, or affecting a balance sheet, that definition almost flips entirely.
Yeah, that makes sense. Because in the banks world, it's a liability on them, which is, you know, obviously, if they give me the money, then it's a lot. Okay, so it's just depending on the perspective of who's doing it.
Yeah, and I think like if you think about a financial system, it's pretty much a closed loop, right? everything that sort of, every loan that one person receives must have been provided by someone else, right? So you have a bunch of transactions that are closed loop in a sense. And you sort of have a layer of interest on top of that, which just sort of provide the financial incentive to people providing liquidity. But you should be able to always trace someone receiving money to someone giving money. And in a sense, sort of double entry bookkeeping with respect to a company is trying to just reinforce that same like closed loop view of the financial system, but within the record keeping of a single company. Okay. Any other questions or points? I mean, yeah, I don't think this is, you know, super difficult to understand. I just think when you've only ever thought about income, debit and credit have a very specific meaning. And in the double entry bookkeeping world, that meaning is a lot different. I don't necessarily always understand it, but then I come back to this table on here and I'm just like, okay, I may not understand it here, but as long as I'm following those rules, I'm always going to end up with a situation where the books balance.
I kind of wish you handed out a worksheet afterwards for everyone to do the thing you did with the company.
I'm happy to share my slides if that helps. But like, yeah, it's and again, like it's a frustrating thing to have to do. And I can imagine like, yeah, this is why, you know, being an accountant is a thankless job. But again, it's a very transparent way of compiling a financial report, right? I think like for many different professions, it's very difficult for us to know if we've done our job, you know, and we could say, okay, there's no errors in the code, the thing works. But if you're an accountant, you have this one simple thing you have to do. You have to do someone's books and you need to make sure that that accounting equation holds. And if that accounting equation holds, job done.
I know you're not an accountant, but why is it that still sometimes, like, especially in big corporations, it's off? Like they don't nail it because, I mean, that's what auditors are for. Like they usually find some place where it's off.
Yeah, so a lot of times I guess that could just be mechanical because someone's not done depreciation correctly. So depreciation is a big reason why in many cases the asset side is slightly out. So if you're not depreciating correctly relative to the interest that you're repaying on the liability side, you will just get a mismatch. Also, sort of companies have these sort of tricky things where like the values of assets change. So sort of accountants speak about mark-to-market accounting. So if you have an asset and that asset is like gold and you buy the gold at a point and you buy that with a loan, the price of gold is going to fluctuate, but you still have the liability, which is the same, right? So you sort of have to adjust the value on the asset side to make sure it reflects the value of the asset now and not at the time that you bought it. But if you don't do that carefully, you're going to get to a sort of imbalance between the two sides. And in some cases, you know, companies just forget about a transaction. There's a transaction that happens and someone can't find an invoice. So it's definitely not the case. I think that these things balance. And I think that's precisely why you have auditors. But in many cases, the reasons that these things differ are due to some of the complexities of financial accounting, things like depreciation, interest, etc. Yeah, I'm not sure who was first.
Radu was first, so Radu gets to go first.
Yeah, hi, Allan. If we can go back to the example with the company, the last slide where we had the equation.
Mhm.
So let's say that at some point in the future, the company
Mhm.
decides to pay a part of the loan for
Correct.
AutoWorks. We would
Correct.
debit the AutoWorks account
Correct.
and credit the bank account.
Yes, exactly.
Okay, and let's say after 2 years, Sabine wants to get a return of that investment.
Mhm.
Do
So
we debit the capital account
Yeah. So yes, we would need to debit the capital account. Also, if the company is making any profit each year, that profit is also going to be recorded in that account. But yes, if Sabina wants to make a withdrawal of her capital, that would go on the debit side of the capital account. And since that amount would be leaving the company's bank account, it would be credited in the company's bank account.
No, okay, great, thank you.
And then interest, it's also I guess if an interest happens, then you would, for example, you receive it into your bank account as a debit, and then your capital is your account is your credit also. If you're receiving like
so you're speaking about sort of like you're receiving interest on a product that you're offering, or you're paying interest?
You're receiving interest on the product that you're offering, or you've this 50,000 invested.
Yeah. So again, sort of any interest there that you're receiving would then come into your bank account. It depends where the interest is coming from. If the interest is coming from a customer, that would then be reflected there. Although interest, I mean, I guess if it was a loan that you gave out, I guess you could get interest in that way. But yes, that interest will always then go through the bank account, and then whatever would be the relevant credit there will just depend on the nature of whatever that interest is.
Sounds good. That makes sense. Also, Sabina, when you asked a question about how companies like don't record stuff properly, at my previous company, this was pretty like, how do I say? Yeah, not like too complicated of an example, but it was like we were making credit cards, but basically if somebody were to pay a credit card on foreign exchange rate at some point, and then they get a refund for that back, I remember we weren't calculating that as like money was kind of appearing out of nowhere, even though it was just the rate of fluctuation of FX, and it had to be like stored in a separate account later. So that was definitely I remember a bug that we had.
Yeah, and that's why like very often the companies will just have a separate account that just captures movements in the exchange rate. So it'll capture any gains or sort of capture any losses just to ensure that it helps this equation hold. But yes, this is definitely a simplified example. If this is a multinational company offering, like in Max, in your case, credit card products with variable interest rates in different jurisdictions with different exchange rates, then yeah, this quickly becomes a very difficult exercise.
And also auditors just need to find something. Otherwise, something is very wrong if they don't find something.
Yeah.
Okay. Maybe if there isn't any question, I'll just put this into context of why I made everybody listen in on a double entry bookkeeping session. I hope most of us know that we do use double entry bookkeeping within Rafiki. We have multiple accounts there. We have, we mainly talk about the liquidity accounts, but we also have settlement accounts that are there to, whenever we put liquidity into Rafiki. So we always say Rafiki doesn't hold any balances, it only manages liquidity. So the example of, for instance, an outgoing payment is we need to put liquidity into the outgoing payment, and what we do is now I have to think very hard. We debit the settlement account and we credit the outgoing payment account. And then when that payment actually goes through and is sent to the counterparty, and let's say that's like my Rafiki instance is paired with another Rafiki instance, that's my peer. So if that outgoing payment is made to an account at the peer, then we debit the outgoing payment account and credit the peering account or the peer's account. And that's basically a loan that that the peer. Did I mess it up now? I see that Max has his eyes closed. Maybe I messed it up. But yeah, that's basically they are extended credit to us because we haven't settled yet. So the peer is paying out that payment to their user, but we haven't actually settled with them. So they are basically giving us a loan, my Rafiki instance, when that transfer is happening. So that's why, like, this is how we use double entry bookkeeping and Rafiki, and there was always a lot of confusion. So hopefully this is a little bit more clear now how the concept works. We do have a page on that in the docs, which I think still needs to be redone, but it has all of those T accounts in there with like the debit and the credit, and it shows where like different scenarios and which accounts would be touched. So thank you everyone for listening in, and especially thank you to Allan to introducing that concept to those of us that weren't that familiar with double entry bookkeeping.
Thanks so much for having me. And if at any point you need me to give unqualified advice about something outside of my area of expertise, I'd be very happy to do it again.
Well, I did ask you for an accountant, if you knew of an accountant that would do that, and you were like, I can do it myself.
Yeah, the accountants would complicate things.
Yeah. They probably came in with like this big IFRS and be like, let's look at this.
Yeah, there'd be pre-reading for this meeting and take-home exercises. Okay, thanks everyone.
Thank you very much. If there's no last-minute questions.
Thanks, Allan.
Thanks, Allan.
Yeah.
All right.
Bye.
See you soon.
Thank you.
Thank you. Have a great day.
Bye. Thank you.
Bye.
Thanks, Evan, for organizing it. Bye. Have a good evening.
Bye.